This contractor made $80,000 last month, but couldn't pay his crew on Friday. Sounds familiar? In the next 12 minutes, I'm going to show you the exact money management system that saved his business and can transform yours too. I've cleaned up over 500 messy QuickBooks files for business owners who thought that they were profitable, but were actually losing cash. So today you're getting the same framework I use with my clients, the 4-pillar money management system that turns financial chaos into predictable profit. Here's what's killing your business right now. You are making decent money, maybe $20,000, $50,000, or $100,000 a month, but you have no idea where it's going. Your bank account looks like a roller coaster. You're constantly stressed about cash flow, and worst of all, you're working 60-hour weeks, but taking home less than your employees. The SBA says 82% of small businesses fail because of cash flow problems, not lack of sales, cash flow. So that ends today. Pillar 1, stockpile during feast, survive during famine. This is the survival strategy that really separates the businesses that last from businesses that crash every slow season. Personal story, I had a client, landscaping company, making about $60,000 in May, spending every penny on the new equipment. And then January hit, he only was making $12,000 a month, but $25,000 a month bills were still existing. So he was living like every month was spring, but winter doesn't care about your cash flow. 2 years in a row, he nearly went under every January until he fixed this. So during your big months, you're thinking like you're rich. New truck, better tools, higher professional draws, but your business has seasons and winter is coming whether you plan for it or not. So here's the system to follow. Month 1 of the busy season, pay your annual insurance and other expenses that can be paid in advance in full. Yes, the whole year. One less bill for 12 months. Month number 2, prepay your vehicle insurance, business licenses and annual fees. Month number 3, build your winter fund. 6 months of basic operating expenses in a separate account that you don't touch. Month 4, now you can think about equipment and investing into growth. The math that saves you, well, let's say you make $50,000 in good months and $15,000 in bad months. Instead of spending that extra $35,000, you're banking $20,000 of it. So then you have $80,000 stockpiled, and that covers you through the worst months without panic, borrowing, or sleepless nights. Set up automatic transfers the day that big payments hit. Don't trust yourself to say manually when you're feeling flush. I make my clients treat their seasonal reserves like taxes, non-negotiable and untouchable until winter hits. Pillar number 2, track your real costs. This is where most business owners get destroyed. If you're curious what real costs are, let me explain it real quick. Real costs equal everything it actually takes to do the job. Think of it like making a sandwich. What you see is bread, meat, and cheese. What you miss is your time, electricity for the toaster, wear on your knife, gas to buy groceries, part rent for using your kitchen. In business, what you see is materials and worker wages. What you miss is your truck gas, insurance, your time, tools wearing out, office rent. The trick, add up everything it costs to do one job, not just the obvious stuff. For example, you think a job costs $1,000, but the real cost is actually $1,500 when you count everything. Now you know why you're always broke even when you're busy. The bottom line is that if you only count the obvious costs, you're working for free and don't even know it. My client Lewis runs HVAC company, thought he was making 30% profit. When we dug into his numbers, he was actually losing money on 40% of his projects. He wasn't tracking vehicle costs, insurance, his time, equipment depreciation. Here's what you're missing: your actual hourly rate as an owner, vehicle expenses per mile, insurance allocated per job, equipment depreciation, overhead allocation in general. Track material costs, labor costs, equipment costs, and overhead per job. If you're not making 20% profit minimum, fire that type of work. Pillar number 3, forecast your cash flow. You need to see money problems before they happen. I'll explain what cash flow is in less than 2 minutes. It is your business bank account's heartbeat. Think of your business like a bathtub. Water flowing in, money coming from customers that are paying you. Water flowing out, money you spend on bills, supplies, payroll, and so on. Good cash flow, more water coming in than going out. Your tub stays full. Bad cash flow, more water going out than coming in. The problem, even if you're making sales, the water coming in. If your customers pay you slowly, but your bills are due now, then you can drown even with a successful business. Here's the real example. You sell $10,000 worth of work in January, customer pays you in March, but rent, payroll, and supplies are due every month. That's 2 months of water going out with nothing coming in. So really, cash flow isn't about how much you sell. It's about when money actually hits your bank account versus when you have to pay your bills. You can be very profitable on paper, but broke in real life if your cash flow timing is wrong. Here's the system: the 13-week rolling cash flow forecast. Every Monday, you have to update money coming in by week, money going out by week, running cash balance. I use a simple Google Sheet template. Column A, week ending date. Column B, starting cash. Column C, money in. Column D, money out. Column E, ending cash. If any week shows negative, you fix it. Not when you're broke, right now. And the pro tip, always assume customers pay late. If it says net 30, expect it in 45 days. If they say the check is in the mail, expect it to be another week. Pillar number 4, measure what matters. Stop drowning in spreadsheets. You have to focus on 5 main numbers. Number 1, gross profit margin. That is how much you keep after paying for the direct job costs. Think of your business like a lemonade stand. You sell lemonade for $1. Lemons, sugar, cups cost you 40 cents. You keep 60 cents. That's your gross profit. Gross profit margin is 60%. In your business, you charge $1,000 for a job. Materials and labor cost you $600. You keep $400. That's your gross profit. Your gross profit margin is 40%. Why does this matter? If your margin is too low, you're working your butt off just to break even. You need money left over to pay for your truck, insurance, your salary, and actually make a profit too. It's not about how much you sell, it's about how much you keep after paying for the work itself. So revenue minus your direct costs, it should be 50% minimum for service businesses. Number 2, operating cash flow. That is money that's left after running your business. Think of it like your personal paycheck. You earn $5,000 a month. You got rent, groceries, car payment, $4,200. You have $800 left. That's your operating cash flow. So money comes in from customers minus all your monthly bills. What's left is operational cash flow. Good operating cash flow, you have money left over each month to grow or to save. Bad cash flow is, of course, when you're spending more than you make. This really tells you if your business actually makes money or just looks busy. Number 3, days sales outstanding. It's basically how long customers take to pay you. So make sure it stays under 45 days or you need better collection systems. Number 4, current ratio, which answers the question, can you pay your bills without panicking? You need to divide what you have by what you owe. For example, you have $3,000 available. You owe $2,000 in bills. 3,000 divided by 2,000, 1.5. What does it mean? Above 1.5, you're healthy, you can pay your bills and sleep at night. Below 1.5, that's a danger zone. 1 slow month and you're scrambling. Below 1, you owe more than you have. Time to panic. This number really tells you if your business can handle a bad month without you losing sleep or borrowing money to pay bills. It's like asking, if clients stop paying me for 30 days, would I survive? Number 5, owner's pay. Are you actually making money or just creating a job? Think of it like this. You are the boss, but you are paying yourself like an intern. Take what you pay yourself, divide by total business income. For example, your business makes $50,000 a month. You pay yourself $5,000 a month. So if you divide 5,000 by 50, you get 10%. What does it mean? Between 10 and 15%, you're doing all right. You're functioning like a real business owner. Under 10%, you created an expensive job for yourself. Below 5%, you're working for free while everyone else gets paid first. If you are making $100,000 in sales but only taking home $3,000, you're sadly an underpaid employee of your own company. Your business should pay you first, not last. If there's no money left for the owner after paying everyone else, your business model is really broken. You didn't start a business to make less money than a regular job. So check these 5 numbers every Monday. It only takes 10 minutes. Red, yellow, green system. You know, red means emergency action required. Yellow means watch it closely. Green means you're winning. Here's what happens if you ignore this. The National Federation of Independent Business says the average small business owner makes less per hour than their employees when you factor in all the hours worked. You'll work yourself to death, stress out your family, and still go broke. I've seen guys with $5 million businesses lose everything because they couldn't manage the cash flow. Great at their trade, just not that good at business. Don't be like that. You started your business to make money and have freedom. Focus on that. If this helped you, hit subscribe button and leave me a comment. Tell me which pillar you're going to implement first. Remember, busy isn't the goal. Profitable and peaceful is. I'll see you in the next video.